Thank you for joining us today for our webinar, Why a Recapitalization May Make Sense for Your Company. My name is Chris Casey, Managing Director with WindRock Wealth Management. I'm joined today by Terry Bressler. Terry is a Managing Director with Prairie Capital Advisors. Terry, tell us a little bit about your firm.
Prairie Capital was founded about 20 years ago, a little less than 20 years ago. And we were founded to focus on ownership transitions for owner-operated businesses, which include both management-owned and family-owned businesses. Basically, our firm provides these services through our investment banking group, our ESOP advisory group, and our valuation and financial opinions group. We're headquartered in Chicago, 2 offices in Chicago, and then have a couple of offices, one in Cedar Rapids, Iowa, and Philadelphia, as well as Atlanta.
Great. Well, Terry, we at WindRock Wealth Management, I'm sure just like Prairie Capital Advisors, are constantly dealing with business owners. And one of the main decisions they have once they have a sizable business is transition, ownership transition. And there's different criteria to guide them whether or not they should be looking at an outright sale or some other options. Can you tell us a little bit about what this criteria, what they are, and also how that leads them to various decisions?
Sure. Well, first of all, like I mentioned earlier, our firm focuses solely on ownership transitions and the various alternatives. And within those 2 areas, we kind of lump them together in 2 big categories, either an external sale or an internal sale. And predominantly in an external sale, that's where you sell to either a strategic buyer, a private equity fund, and you can do that in part or in total in the case of financial buyers in part. On the internal side, though, we also focus on employee stock ownership plans, which is ESOPs, management buyouts, which again is selling internally to a management team, or trying to distribute shares in some fashion to other family members to concentrate perhaps the ownership in the younger or next generation. And then under the internal sale also sometimes recapitalizations occur.
A lot of people have heard that term recapitalizations, and business owners have heard it from various advisors in the deal community. What exactly is a recapitalization, and what are some of the different goals or reasons that a company owner would look at them?
Yeah, and that's a good point. We usually start out by trying to assess the goals and objectives of the shareholders who are wishing a transition. And some of these goals and objectives include how much of the value of the business they want to get. That is, are they really looking for the highest valuation possible? We also try to address whether they need total cash for their business or some subcomponent of the cash, try to do something less than a total sale. We look at their own personal financial condition as well and see if a recap or some other transaction can help out their personal balance sheet situation. We also explore legacy issues, and those are really like if they might be in a small community in, say, downstate Illinois, and basically whether they feel they need to kind of keep the business going in that community, or they have some personal relationship or desire to keep the business with employees, and so that's important and comes under the broad category of legacy issues.
I've noticed that with a lot of business owners. It's either making sure that they take care of their employees, that everyone continues with the firm subsequent to their transition. And a lot of times, sometimes it's simply the name as well. They want to keep the company name.
Right, and that's really important. When you sell a business, of course, you lose the right to kind of keep your name on the door. Sometimes it's kept on the door, but you can't really control that. And that's why legacy is important. And there are ways to do that if it's important to the family to continue to have their family associated with the business. Likewise, management teams are important. Sometimes an owner wants to sell to the management team, but management teams are also important in a recapitalization, and we'll get into that momentarily. The other thing, too, is if it's a family business, keeping the business in the family is many times an objective. And obviously selling a business is not keeping it in the family, which kind of leads back to a recapitalization transaction. And then also future growth opportunities. It might simply be that the family is tapped out and feels that the risk of growing the business just doesn't really fit with the risk of their family situation, and they may want to get an outside partner in, which kind of leads to a change in shareholder ownership, or at least the composition of the shares.
There's a lot of different criteria to look at. Tell us about recapitalizations. What different kinds or types exist?
Yeah, well, basically recaps come under two major and then one kind of sub-major category. First of all is an equity redemption recap, and simply put, that's where you're using some form of capital or cash to redeem equity in some manner from shareholders. Another major type of recap is a dividend recap, where all the equity stays in place, but there may be retained earnings that has been accumulated in the company, and a big special dividend is desired. And so a recap can affect that as well. And then the last category is kind of a non-optimal sale of a business, and that can occur like in the last recession, where perhaps there's a need for some kind of liquidity, but it's really not the right time to sell the business. But yet the family or the owner needs some kind of liquidity. And so we can devise a transaction where they can take out a measure of liquidity, still own the business, and then wait and sell the business later when the value has appreciated or it's a better time to sell.
Now, I know you put together an example that you can walk through. So why don't we, it's probably easier for a business owner to understand the mechanics of recapitalization if you walk through an example. Why don't you go ahead and do that?
Yeah. Well, first of all, let's just start out with the starting point. And this is a very simplistic balance sheet that basically kind of will be used as a diagram to go through the ins and the outs, if you will, of a recap. So first of all, you got cash, working capital, and then some long-term fixed assets, which would be plant and equipment or things like that. So that's the asset side of the balance sheet. On the capital side, you've got some form of debt, whether it's from a bank or some other lending source, mezzanine capital, equity, and then, of course, retained earnings. And so this is typically the starting point of any recap transaction with a company. So let's first look at the main category, dividend recaps. And on the diagram, you can see the ins and the outs. And so the A, the mustard-colored A, shows that we go out and borrow money from a bank or other lending source. And so that comes onto the balance sheet as more debt. But then also, because in accounting you've got debits and credits have to equal one another, because we borrowed debt, we've got an increase in our cash balance. And so that's the first transaction, borrow money so we can increase cash. And then the second part of the recap transaction is the actual dividend, where cash goes out, and that's represented by the blue B, and the dividend comes out of retained earnings. And so depending on how much you borrow and how much you can borrow, you can do some pretty large dividend recap transactions.
And I imagine this particular type of recapitalization is especially relevant for families that are looking to improve their personal balance sheets or simply want to diversify from the business industry.
Correct. Okay. And many times these dividend recaps, maybe the first generation wants to move themselves a little bit out of the business, build a house in Naples, move the company to the second generation, and the cash coming out of the business might be that dividend to be a down payment on a house in some other part of the country. Now, the other form of recap is an equity redemption recap, and the same thought is here. Now, equity redemptions, as opposed to dividends, they can be much more extreme. You're not blowing through all your retained earnings, or you can't really blow through all your retained earnings in a dividend recap, but you can, take out a substantial amount of equity in an equity recap. And so, in this case, rather than just borrowing debt, we're suggesting with the letter A coming in on the liability side of the balance sheet that perhaps we'll borrow some debt, mezzanine, maybe a little bit of equity to bolster our cash position. And again, that's the first transaction, transaction A. And then the second half of that is redeeming the equity for cash. And so that cash comes out, and then the equity is reduced on the balance sheet as well and comes out in an equal measure. And again, this can be a much more dynamic or a much larger transaction, and so you can borrow mezzanine and equity capital along with the debt to fund the redemption of equity.
Well, every business is different, even businesses within the same industry, and obviously different businesses in different industries are affected vastly by different economic variables. But also businesses that are within the same industry have different capital structures potentially. Can you tell us about what about a company's business risk and its industry as well as its capital structure affects how they should go about considering or the type of recapitalization they should go about considering?
And that's what this diagram is meant to show. It's just the interplay of the various variables of the variables that we have to consider. You know, first of all, on the top of the chart, it's the company business risk, and that's important because companies that have high business risk tend not to have a lot of leverageable capacity. They can't go and borrow a lot of money, and so it will push us into more of a private equity recap category. On the other hand, if it's a very low risk business, you know, something where year in and year out it's very consistent, has a lot of cash flow and doesn't really have a lot of variability, it can actually use more debt capital. And so that's the kind of the spectrum that we consider with low business risk to high business risk companies.
Can you give us an example? Like I would assume that a high business risk would be a company that, for instance, has a great deal of customer concentration or maybe one particular vendor.
Yeah. You know, one thing that is an area is like recreational vehicle industry, for example. It's a good example of high business risk. Very cyclical and very seasonal businesses. And if you went to some of the public companies in that space, or even the private ones, you'd see that they have almost no debt and a lot of cash balances. And so that kind of company needs to be able to withstand a significant downturn like we had in the most recent recession, and then also withstand seasonality in the business as well. And so that's a good example of something with a very high business risk angle to it. You know, grocery stores are another one that basically, you know, they have such narrow margins, you know, 1-2% margins, net margins, you know, and that again, you know, it's not a very leverageable business, so another high business risk company. Borrowing capacity, kind of going counterclockwise, I guess, is on the green box. And basically, again, if you've got a company that has a low business risk, but say it's already very highly leveraged, you know, it's going to give you, you know, something that is not an optimal set of circumstances to do a recap. And so basically, if you've got if you've got high borrowing capacity, you can use some of that to leverage up it or do a recap transaction using leverage. The desired liquidity, which is on the bottom part, again with the spectrum of low to high. If you need a high measure of liquidity, obviously it's pushing you more to the private equity recap, versus if you need a lower measure of liquidity, that's more in the debt recap area.
And this relates to the personal balance sheet liquidity, or is it also part of the business?
It's kind of the desire of the shareholders and what they want to take out of the business. And so that's really the high, medium, low kind of spectrum on that. And then another desire of the business owner is just dilution. How much equity or dilution are you willing to forego or give up in order to accomplish a recap transaction? And so basically, if you really don't want to give up a lot of ownership, you know, put you in a low category and then, you know, put you into the senior debt category. But if you're willing to, you know, give up more than half or, you know, half or a little bit less, you know, you're migrating up toward the private equity recap area as well. And so we consider all of these different variables when we try to structure the recaps. And on that center stripe, it just shows you pictorially where we are. There are senior debt recaps, again, where we're using mostly senior debt capital, many times provided by a bank. We segue up to the mezzanine recap as we increase some of the parameters. And then finally, we hit the private equity recap where we're bringing in a substantial part of equity ownership. And basically, we have high business risk as well. And so all those variables come into play.
We should probably spend a few minutes, and I know we not only on this slide, but we also discussed it in the examples of talking about these various building blocks of capital. We've used some terms that not everyone may be familiar with as far as mezzanine. Right. Can you tell us Who are the providers of these types of capital? What's their nature and how costly are they?
Yeah, and basically the building blocks of capital come in three broad categories: senior debt capital, mezzanine capital, and then equity capital. And basically the providers, and starting with senior debt, providers of senior debt are banks, commercial banks. Other types of lenders these days are business development corps, BDC lenders. And then there can be other special funds like GE Capital or some other lenders that are not really in the bank genre or not really in the BDC area. Mezzanine capital is simply as it's depicted here. It's kind of the seats in the middle. And basically mezzanine capital is provided in some cases by specialty lending groups within banks. But more than likely it's a special type of fund that basically provides mezzanine capital. And then finally, equity capital is equity that's provided largely by the private equity community, the financial buyer community, but occasionally family offices and then sometimes individuals. And you can see, if you look at the cost of capital, that the bank financing market is the cheapest form of capital. You know, typically that's a LIBOR plus a spread loan. And even with the BDC lenders who tend to be more risk-seeking and therefore more expensive, you know, you're looking at costs of capital that could be on the extreme low-end bank market, you know, in the 2.5%, 2% range, all the way up to 7-8%. Mezzanine in the middle is pretty much, it's a coupon plus a PIK these days, and a PIK is actually payment in kind interest payment. And so the total interest outlay is anywhere between, say, 12 and 15%, which you can tell is pretty expensive capital. And then equity basically doesn't normally have a current cost of carry, namely it doesn't get any interest payments or dividend payments, but because of the nature and the risk that the equity fund is taking, basically it's got returns that are in the low 20s to high 30s. And basically, just to comment on growth strategy and the use of these capital, if you don't have a lot of growth, then a bank financing is probably what you can look at. But if you do have modest or middle growth, medium growth to high growth, then something more like mezzanine or equity capital would be required.
And just to be clear, and I know you do have this on with the building blocks under equity, but I know you broke out equity between minority, non-control, and control. So there are plenty of firms that will invest for those businesses that wish to keep a controlling interest. There's plenty of firms out there that will invest an equity proportion as a minority interest.
Correct.
Does it vary the cost between control and minority? And when we're talking about minority, how much of the business are they looking at acquiring?
Equity funds used to be control only, but now just given the fact that there's a tremendous supply-demand imbalance, that is, there's not a lot of deals out there, a lot of equity funds are looking at doing, 30, 40% type of investments in companies, where in the past they'd be 50% plus. They want a total control. But now there's also, if you think about it, the mezzanine and the equity markets actually are a continuum. And so there are a lot of funds that play kind of in between those two categories, broad categories, and can do minority deals as well. The differentiating feature between a mezzanine deal and an equity deal, though, is that a mezzanine deal requires some kind of current pay element, an interest payment, whereas an equity, even a minority equity, doesn't really have a current cost to carry. And so depending on the circumstances, and going back to the goals and objectives we talked about earlier, we try to play somewhere in between and try to get the right capital for the right circumstances. One last thing, too, is just flexibility. Basically, because of bank covenants, that's the kind of flexibility we're talking about here. And so a bank, because they're not getting any upside, they're just getting an interest payment, they're going to want to have more control over the circumstances in which they're lending versus an equity fund where they'll have control, they'll have a board seat and some other type of soft control, but they really want to make the business go and get as valuable as possible. And so they would provide greater flexibility to kind of operate the business to the business owner.
I know before we walk through some examples, but let's put a time element to it and talk about, kind of drill down on the actual steps for a transaction when we're talking about a recapitalization here. I know you have a slide that deals with that.
Yeah, basically a recap process can take anywhere from a couple of months on the extreme low end up to about 6 months. And so it's really 14 to 21 weeks is kind of average here. And basically, when you do a recap transaction, this isn't really something that somebody does as a hobbyist. You should probably get an advisor, both a good legal advisor, a good attorney, deal attorney, as well as an investment banker involved to prepare yourself for the process. Basically, preparation is just trying to determine goals and objectives, get the offering materials, the confidential information memorandum, and things like that together, as well as develop a strong list of buyers or investors in the deal. Basically, the investment banker takes over in the initiation of the process, contacting the investors, discussing the deal, proposing the structure, and guiding the process. And then once that step is completed, hopefully at the end of that, you get a number of potential investors where the investment banker and the owner will showcase the company in meetings, one-on-one meetings, such that at the end of that part of the process, the banker and the client basically can negotiate the terms and kind of solicit alternative term sheets, hopefully, and then selecting one investor, one term sheet set basically, and then executing the transaction and closing the deal. And that's the last stage is actually where the attorneys come in and play a large role with the definitive agreements. So again, it's a very, at least compared to an M&A sale process, pretty quick process, taking about 2 to 5 months or 14 to 21 weeks.
What's interesting, I know a lot of business owners in my experience, too many unfortunately, view their options as either I'm going to sell the company or I just hang on to it and I don't sell it. And there's a whole really spectrum of liquidity alternatives out there, and obviously recapitalizations, as you've described, are viable, a very viable one at that. How can people get a hold of you and Prairie Capital in general?
Well, the next slide has contact information. So I would encourage any of the listeners to be sure to give me a call if there are any questions, if there's any interest in just hearing more about recap transactions.
And I know I'm on your mailing list. I get a number of different types of material from you guys. Can you tell us what's available if someone's interested in receiving some information from Prairie?
Yeah, specifically on the topic of recaps, we've got a white paper which is on our website, and you can contact through the slide link here. We also put out something on a quarterly basis, which is the Prairie Middle Market Perspective, which is our assessment of the M&A and financing markets. And there's a lot of information just on recaps, at least the current market for recaps in the private Prairie Middle Market Perspective as well.
Great. Well, thanks for your time today, and I'd encourage anyone that's considering a sale or considering an alternative just to explore these. I assume you're always happy just to speak with people even if they're not locked in or committed to a particular decision.
No, some of the best transactions I've ever worked on were the result of 2 or 3 year courtship of an individual. And so I don't mind answering questions. In fact, I encourage it. I really like to talk deals.
Well, great. Well, thank you again, Terry. Thank you.